WeWork is making moves to go public again, but this time it's through a SPAC deal versus a traditional IPO. The office sharing company has agreed to merge with the SPAC Bow-X Acquisition Corp, and the deal will take WeWork public 2 years after its failed IPO. The merger, valuing the company at $9 billion, a huge drop compared to its $47 billion valuation in 2019, but slightly improved from its value in a SoftBank-led bailout round later that year. So joining me now is Jannarone. He's an editor-in-chief at IPO Edge. John, it's always good to see you, and thank you for joining on Friday afternoon. What is your take on this deal?
Well, it looks pretty good, believe it or not. I mean, this is night and day. I don't know if I was talking to you, but I was certainly on the show going through those filings when they tried to go regular way IPO, and it was a train wreck. They really cleaned it up. They're emphasizing there's new management in place. And something I'd point out, a little bit of history that I find interesting. So Masa at SoftBank put his right-hand man at the helm of this business. I mean, he took it very, very seriously. They cut costs across the board. And Kristen, the most important thing I would say that I noticed in the presentation is that they're going to be profitable this year, at least in the fourth quarter, which is extraordinary because I think you might remember when they were going public regular way, no one had any idea when they were going to be profitable, and that was one of the big complaints.
Definitely. I remember it was those financials and the SEC filing that initially didn't make sense, and then all of the stories that came out about Adam Neumann in particular that did hurt those chances and bring down its valuation just several years ago. How does it get to profitability, John?
Well, they really cut costs. I mean, there was a lot of strange stuff going on inside that company, as you might remember, Kristen. So they took out a lot of the peripheral ancillary businesses and are kind of focused on what we know them to do, right, which is the short-term office lease space. And by the way, I really do believe that that sector has enormous tailwinds over the next few years. People aren't just going to go straight back and sign up for 5-year leases for big offices. They're kind of gradually creeping back into it. And that flexibility, I think, is something that employers across the board are going to consider pretty seriously.
So it has a ton of real estate. I mean, is there any update as to how much real estate still exists 2 years later after that initial attempt for an IPO, as it did look to bring down its costs?
Yeah, I think they still have quite a bit. There's no doubt about that. And by the way, Kristen, they lost $2 billion last year. But now, of course, it was the pandemic. But I think that they really have. They've really already locked in quite a bit of commitments for 2021 already. As I recall, it's over $1 billion. And they're also expecting not just to turn profitable, but to turn very profitable in say the next 2 or 3 years. So on a valuation basis, Kristen, it actually looks pretty reasonable. And you might have noticed the stock popped today, which is extraordinary considering the hard time that most SPACs are having right now.
Let's talk about that, the hard time that SPACs are having. I think last year was the year of the IPO, the year of the SPAC, the year of the pandemic, clearly. But what state is the SPAC market in right now, John?
I would say there's a glut. I would say there are too many. And what's happening is you're seeing a lot of these, whatever XYZ Acquisition Corp 1, 2, 3, 4, 5, 6, 7. They're just issuing like crazy. So there's so much of this money, swashing around out there that I think investors are a little bit unclear about, which are the good ones to go for. And so, with so many choices, you've got to really, really stand out. And that's why, just stepping back, there are dozens and dozens of SPACs out there that are trading below the value of the cash that they have in trust, which is really interesting because, in theory, you could just buy any of those and turn it in for the cash. The only issue is you've got to wait for the entire period that they have, 18, 24 months to go through. But we're in a really weird spot right now. But again, for that to pop 10%, especially given the besmirched reputation that WeWork has, was really impressive for me to see this morning.
John, I also want to get your take here on another SPAC deal that was also announced today by the Wall Street Journal, reporting that the sports news site The Atlantic and the news startup Axios are in talks to merge via a SPAC, and that some digital media properties would be rolled up into this. What do we know, and how significant is it?
Well, it's a news report, so we don't have any numbers yet, Kristen, but it's really interesting to see this. I, for one, in my perch, I'm very happy to see media assets be bid higher. So that's good news. But what's interesting about it is the sports element of it, Kristen. I mean, I think that, sports is something that has, ever since I've been, a financial journalist, been fascinating because of the very, very high premium that those assets command. And so I think that it's probably a good thing for Axios. I mean, Axios has various other things going on, but you might remember over the years, these the Bleacher Report, for instance, was bought by Time Warner, which is now Warner Media, for a very, very high price tag. That deal worked out fantastically well for them. But if I might just slip something in here, there's a company which owns the Football Hall of Fame, which went public through a SPAC, and it's trading at $5, of course, down from 10. And I think that's a sleeper. I think that could be really interesting. Once people start coming back, I mean, like I said, I love sports assets. And if you want deep value, I think that's one to look at. The ticker is HOFB.
All right, John, we'll look into it. Always good to see you. Thank you for joining again on this Friday afternoon. That's John Jannarone, editor-in-chief at IPO Edge.